I wanted to make this video to kind of explain what you should expect and what you should aspire to as a trader in your first 3 months of trading, whether it's Bitcoin or stocks or whatever. The reason why I choose 3 months is because 3 months seems to be the cutoff point where most traders get wrecked, dissuaded, or quit. And it's mostly because they're gambling, they're not really investing. And most traders trade like this. Most traders put too much of their stack in, they expose their account to too much risk, and the market will always tell you if your strategy is wrong. The only way to profit from a successful strategy is to test that strategy over time and get a true win rate for yourself. Otherwise, how do you know how good of a trader you are if you've only done 10 trades and you're always putting 10% of your stack in at a time? If I could boil this video down into like one sentence, it would be that if you can go your first 3 months and not lose from your original starting point, you're already at a huge advantage. You have to first maintain before you can gain. The first step is to maintain. And then once you learn to maintain, then the gains start coming. So what you need to do in your first 3 months is to create a strategy based primarily on survival. You must retain before you gain. Technical analysis can take years to get properly adapted to fully, but in 3 months you can really learn a lot about TA. You can find a path of least resistance for yourself, enough to formulate a basic trading strategy for yourself. But yeah, dabble in the technicals a little bit. TA can be up to 70% accurate, so you definitely want to get familiar with that. Invest, do not gamble. So come up with some sort of year to 5 year plan and throttle yourself on a daily basis, so you're not risking more than 1 or maybe 2% of your stack per day. When you enter a trade, you have to kind of make a mental note or even write down what that indication was that brought you into that trade. So the VWAP crossing over the zero line, for instance, that would be my trigger to long. So I long when the VWAP crosses over the zero line. So it's not only about knowing why and when you enter, it's also about knowing when you exit. So if you're going to enter a trade on a trigger, every trigger kind of has like a counter trigger, So you need to know the trigger that's going to get you out of that trade, not just the trigger that gets you in. So when CryptoFace talks about trigger waves, he talks about how one wave is bigger and then the next one is smaller, and sometimes it even creates divergence where the price action is going down but the momentum is like rising. It doesn't have to create divergence, but the big deal is that declining negative momentum. When that momentum wave clips, that's kind of your trigger to long. But what is the trigger to exit? And the trigger to exit would probably be once it crosses that zero line and kind of enters the range of overbought and then clips down. That most certainly is your trigger to close that long. With the VWAP, your trigger to long is when the VWAP crosses over the zero line. So that means that your trigger to exit would be when it crosses below the zero line. But too often what people do, what new traders do, is they don't plan their exit with their entry. And it's not a hard number. The exit isn't even like a hard number. It's more of a bit of data that you're looking for, like a reading that you're looking for. So it's hard to say, oh, like a 10,400 is my target, but it's easy to say when the VWAP crosses down, I'll exit this trade. So you have some sort of process or system that's replicable and testable that you can build over time. And that is the secret to a successful trader, is you are abusing your liquidity and you are only risking small snippets of your account at a time and never betting more on one trade than another, because it is all just a numbers game. And over time, in as short as 6 months, you can double an account just going off of like a 12-hour chart. You definitely need to know the relationship between risk reward in this space. To have a successful trading strategy, you don't necessarily need a great win rate. You can actually only win 30% of the time and still profit by having a 3-to-1 reward risk ratio. So let's say you trade 10 times, you lose 7 and you win 3. So if you only lose 1 when you lose, but you always gain 3 when you win, after those 10 trades, you'll have lost 7, but you'll have gained 9. So even though you had a 30% win rate, you're still in profit by 2. So that's kind of the concept of risk reward, and that's how people profit in this game. And that kind of shows you the power of liquidity, the ability to always have more money, the ability to never sweat any one trade. Yeah, don't get attached to losing trades either. New people kind of have this idea of liquidity of like, oh, if my trade goes south, I'll just dollar cost average and it'll eventually come up and save me. Dollar cost averaging is a strategy used, in my opinion, for hodlers and for bots. If you're going to be trading as a sentient human being, you probably don't want to be babying losing trades. You want to be babying winning trades. So what I mean by babying a winning trade is like, if your trade goes into the green, you need to be thinking of ways to abuse that positive risk scenario by placing a stop in profit or adding contracts, raising your average position as the price is going up in this larger uptrend. Things like that. You're maximizing this positive risk scenario. The other guy who was in a losing trade, and now he's dollar cost averaging and putting more and more of his money into this losing setup, and if his initial indication was wrong, he loses it all. That's the issue here, is that second trader, he's exposing his account to catastrophic loss. By catastrophic loss, I mean like the meteor that destroyed the dinosaurs. I'm talking about like a 5,000-pound fat lady walking onto an elevator. I'm talking about a cannonball landing on a trampoline. Just, there's going to be these times where there are these mass extinction events in a market, especially in crypto. In crypto, it's like every day. So, knowing that, you have to have a strategy that accounts for those events. If you were creating a business and every week something happened where if you didn't prepare for it, your business would go bankrupt, then you probably don't have a good business model. You need to be able to account for various risks that are threatening your plan or your situation. There's different ways to manage risk. You could absorb it, you could avoid it, you could share the risk with other people, so spread the risk around across multiple parties. Um, you get the idea. But high impact, high frequency risks, if it's either of those, you don't want to be absorbing those because they either happen so frequently or they hit you so hard or both. And in my opinion, liquidation is a high frequency, high impact risk that if your account is exposed to it, there is no way you're lasting more than 3 months, in my opinion. So that's why I made this video of the 3-month new trader guide, because 3 months is that cutoff where most traders lose their appetite. A lot of them get wrecked. A lot of them get dissuaded because after 3 months they're nowhere further than they were when they started. And yeah. So yeah, the most important thing is to retain and then gain. It's very important to take advantage of those positive risk scenarios and make sure you profit as much as you can on those. But the thing that threatens most new traders the most is those catastrophic losses. If you can rein in, if you can be real about yourself and the liquidations that you are absorbing, then you can change and alter your strategy for success. But if you're not profiting and you've been in this for more than 3 months, then that might be what is wrong with you. Is you're risking too much of your portfolio in any one trade, and so when that trade loses or goes south, then you kind of have these huge losses. It's almost like getting a chunk of your leg eaten by a shark. Like you can't walk afterwards. It's not like losing a 1% or a 0.5% or whatever, and then you're okay for tomorrow. It's about you got your leg eaten off, and like you're not even in the right mindset to be trading right now because you took such a huge loss. On top of that, recovering from losses gets exponentially more difficult. So if you lose 1% of your stack, then it's pretty much just 1% gain to get it back, because 1% of 99 is pretty much the same as 1% of 100. If you lose 90% of your portfolio, you have to 10x your account from there to get back to where you started. So just think about that for a second. If you were someone who put all of your crypto on the exchange and traded with too much, and then this happens to you, like you're wiped out. And this is why like these exchanges are so profitable, because a lot of people come in and they think that just because they're following signals or using a pro indicator or this guy said this thing on YouTube or whatever, they think that that is actually their cue to bet heavy, bet the farm. Unfortunately, no matter how good an indication is, it's just one day out of hundreds. And so that day shouldn't be treated any differently in your risk reward than any other day. There's going to be some times where that VWAP crosses up and it doesn't cross down for a month and you're just sitting in that trade profiting. There's going to be other times where the VWAP crosses up, goes up a little bit, and by the time it crosses down, the price is actually lower than when you started, and then you have to exit at a small loss. That'll happen too. But having a simple strategy and managing your risk over time is the formula for success. When you lose a huge chunk of your stack, you are inclined to bet an even larger chunk of your stack to kind of recoup those losses that you got. Like let's say you lose half of your account. That means you have to 2x your account from here just to get back to where you started. And that is terrible for the human psychology, in my opinion. It kind of You're kind of pressured to put that other half of your stack in at a higher leverage than before to get your 100% back. But this is the downward spiral that many new traders find themselves in, where they are like revenge trading, and eventually they walk away with nothing. The only people who succeed in this environment are those who have tons of liquidity, or at least emulate someone who has a lot of liquidity, and they have many plays over many days. They retain and then they gain. And this is definitely not what you want to hear, but 3 months. Just know that 3 months is the cutoff point where most traders quit. So you have to differentiate yourself from that pack, because that pack, those are the retailers. And I don't like calling the people in our group retail traders, but like my brother and I are in this like educator kind of role, I guess. And then you guys are in this like retailer kind of role. And then you have like the ByBit exchange, which is like the broker. And it's like this three-way ecosystem where there's like conflict of interest and shit. Like ByBit wants all of us to get liquidated. That's their name of the game. The educators are getting affiliate pay. So in one sense, there is kind of a conflict of interest there. However, if the educators can help these traders trade longer and more successfully, you actually get more affiliate pay over time. So the educators are actually incentivized to help the retailers trade better and for longer. That way we benefit from that affiliate system. Most YouTubers don't take advantage of this relationship. They actually just put their ByBit affiliate link below their videos, and that's the last you hear of them. So you're basically just supporting them like you would through Patreon or something, and you're not really getting much out of that. So I'm grateful for that, but it's very important to take note of the conflict of interest here between the exchange and you. They want you to get liquidated. They want you to put a huge portion of your stack in at too high leverage, and they want you to put more money into a losing trade. ByBit loans you up to 100x leverage without even asking you for a driver's license. Just remember that. The competitions are a scam. It's all just a game to further the narrative, and all the YouTubers do the song and dance and pump the contest and all that. But if you really look at what's happening here, you're basically just forcing a bunch of retail traders to trade on this shit coin that they wouldn't have traded normally during an inopportune moment where the market is in this kind of point of macro indecision. So you're forcing all these retailers to trade in a point of indecision, and they're all going to get wrecked for the sake of the contest. It's just one big narrative that the broker pushes, and they kind of rely on the YouTubers to further this narrative. And so that's why I kind of try to like distance myself from that. It makes me want to like just do my best educating you guys, helping you guys last as long as you can, and come up with real trading strategies, not just waking up every day and I don't know. You don't want to treat this like a crack addiction. This is like a side gig or a career or a business or whatever you call it. You want to stay humble. You want to be humble. You want to stay in your lane. You want to listen and absorb. You want to find a good variation of media sources and news sources. So you want not just crypto sources, but other industries that are related to crypto. You want to follow those as well. You want to know all the big names in crypto. You want to know, a couple trusted news sources where you can get crypto information from. And with YouTubers, I would say it's not that important to keep up with what the YouTubers are saying. But find a few that you can find trusted, reliable information from. But at the same time, Nothing anyone says on YouTube is cause for you to bet more than 1% of your liquidity. I want you to just make this rule for yourself that abundance is your friend. And the only way to trade with abundance, like the whales do, is to cap and throttle your risk. You definitely want to be diversified. So no matter how good of a trader you are on ByBit or with crypto or Bitcoin or whatever, if there was some sort of uber mass extinction event, like an exchange getting hacked or Bitcoin getting banned or whatever the hell, are you gonna survive or are you gonna die? So smart investors don't have all their eggs in one basket in any way. I only put money on ByBit that I'm actually trading with. And you definitely want to keep the majority of your coins off exchange. Otherwise, you'll be trading with them, and they're also vulnerable to catastrophic risk. You might want to learn in your first 3 months how to trade with 2 accounts or multiple accounts. I found personally that having multiple accounts on multiple screens helps me to separate my scalp philosophy from my swing philosophy. And I can treat them, I can basically compartmentalize kind of these two. It's not quite a duality because I wouldn't really call it, it's not that simple. It's not just scalps versus swings. But, and then your swing account isn't always your swing account. Sometimes you might have to turn your swing account into your scalp account and vice versa. It's flexible. But if you can come up with some sort of system where you're more organized like that, and you're not just sitting and babying losing trades while all these other new signals are coming and you're missing out on all that shit, that's terrible. When I first started, it was in my first 3 months where I kind of realized what was wrong with my strategy, which is like I was sitting in these trades for so long and all these other indicators are just whizzing past me and I'm missing all this profit. And then the trade doesn't always come back up. When I was new to trading this, we were in a bear market and it was only a matter of time before things went down. So yeah, I think that's all I got for today. I just wrote down some notes and I just wanted to articulate them and get these thoughts out to you guys because it's very valuable information, especially for people who are newer and don't necessarily know all these things. Some of these concepts are like first principles to anyone who's been trading for an extended period of time, but as our group has gotten bigger, we kind of have the full spectrum. We have pros and we have total noobs. So some of this info is very important, and I just want you guys to find your happy place in the next few days. Find some environment that's relaxing and peaceful, and think about the long term here, and don't put all your eggs in one basket, and diversify. And you got to be like Voldemort, you know, you got to like split your soul into like 9 pieces, and you'll never die like that. So there is a way to maintain in this environment. It's not just gambling. It's not like blackjack where when you lose, you just lose your chips. There are tools that you can use to control your risk. And so in a kind of twisted way, any loss that you incur, you welcomed upon yourself. It's like a vampire tapping on your window. You know, do you let the vampire in? If you let the vampire in, he will eat you. But you are the one who must open the door. Only you can pull the trigger. And so through consistency and dedication and the pursuit of knowledge and truth, we find the true value of a given stock. With all of our heads put together, we debate what things are worth. And it is a never-ending cycle because the environment experience itself is always changing, and no order can last forever before stagnating. And when an order becomes stagnant, a revolution must take place. And so those who can smell the order stagnating and I guess adapt to the new order when it starts showing its face, those are the individuals that will be selected to live on. But to those who cling to the old order and die with it, to those whose strategies don't survive apocalyptic events, they just get selected out. And these are friends, mothers, fathers. These are human beings' lives that are at stake. So this information is of utmost importance. I just want you guys to take all this to heart. And thank you so much for listening. Please subscribe to the channel. Make sure you like the video. Join our Discord. And if you guys like this format, definitely let me know. And if you guys have anything else to add about risk management and all that, just put it in the comments and let's start a little discussion here, because I think that risk management is actually more than half the battle. The technicals are only one piece. So while tools like Market Cipher give us an edge on that side of things, it's always going to be up to us to manage our risk. So without further ado, you guys have a good day. Thank you.